for our view, or let's say the key topic is, it relates a bit to what we heard before on the mountains. Yes, here we go. And as you see, the title is a bit similar, yeah, so, but for us, the view from the top of the mountain is not so clear as we've seen on the very nice pictures before, yeah. And in essence, it boils down to these two charts, yeah, which I think are probably the most important ones that I can show you. And what you see here for the Fed on the left and for the ECB on the right is basically just a decomposition of this whole tightening cycle that we've seen now for 1.5 years. And what a ride it has been. Yeah? I mean, for the ECB, if you look at it, so the yellow area is what the ECB has actually delivered. And the same for the Fed, and the dark is what the market had been expecting. And we had this very unusual pattern throughout this cycle that the central banks were hiking rates, but rather than scaling down the rate hike expectations, the market added to these expectations. And I think 75 basis points from the ECB, for example, no one had this on the radar going into this cycle. So, and I think this created a lot of the uncertainty and a lot of the volatility, but at the same time, going back before what happened in March, everyone was thinking, okay, once we get to the peak, everything will be clear, and then it's time to take risk again, to go for carry and so on. But of course, there was a slight problem in the US with the banks, and now we're back to this stage that, yes, even with the central banks being done, okay, the Fed very likely might deliver another 25, the ECB probably 2 times 25, but the market isn't really relieved. And I think here, besides what I mentioned, okay, on the US banks, there's probably a lot of you guys who are much better informed than myself, but I think keeping in mind all the risks, it's a bit understandable, but I think overall for the market, the problem has a lot to do with this chart, what you see here. So we heard a lot on inflation before, but here you get what the market is thinking. And this is the 5-year break-even inflation for the euro area, which is probably the best and the most liquid measure that we have for kind of longer-term expectations. Because as we heard, I mean, for consumers or for very short-term inflation expectations, it's a bit trivial, because you take the headline rate that has been released the month before, and this is basically the expectation. And the same if you look at any wage negotiations, it almost matches perfectly. But the key point is that the inflation market has been moving away from pricing these price shocks. And so what do I mean with price shocks? It's a long time ago, but when you think back how this whole thing started, it was COVID and the effect on supply chains, which was triggering this first, let's say, or economists like to call it cost wave. Then, of course, we had the war and the shock on energy prices, and which also gave here these longer-dated inflation expectations another push.